In today's video, we're going to cover the 5 most important types of investment accounts: the 401k, Roth IRA, traditional IRA, SEP IRA, and then the standard taxable brokerage account. By the end of this video, you should have a much better understanding of which type of account is best for you. Let's start with the 401k. So the 401k is a tax-deferred retirement savings account that employers offer their employees. In a traditional 401k, employees contribute money to their account through elective salary deferrals, meaning a percentage of the salary is withheld and contributed to the 401k. Because these are withheld from their paychecks, the contributions are considered pre-tax and only taxed upon withdrawal. In a Roth 401k, employees' contributions are funded with after-tax money, so they are not tax deductible. However, qualified withdrawals are tax-free. Contributions to 401k accounts are made pre-tax in the traditional 401k, meaning the total of the contributions would reduce your taxable income for that year by the contribution amount. For example, if an employee earns $100,000, let's say, and then contributed $10,000 to a traditional 401k, then the taxable income for that year, all else being equal, would be about $90,000. As of 2022, participants can contribute up to $20,500 to a traditional or Roth 401k, with an additional $6,500 contribution allowed for people ages 50 and older. Employers can match a percentage of their employees' contributions up to a certain limit or percentage. For example, if an employer could match 50% of an employee's contribution up to 6% of their salary, and the employee contributes 6% of their salary, then the employer will contribute a 3% match. If the employee doesn't contribute the full 6%, they might not qualify for a match and receive either nothing or a reduced portion from the employer. To receive the employer match, the employee typically must contribute a minimum amount or percentage of their salary. We'll talk about it later, but always take advantage of the employer match. Withdrawals from a 401k are taxed at the person's income tax rate, and there's no penalty for withdrawals as long as the distributions are made at age 59.5 or older. An employee may be permitted to take loans or hardship withdrawals before 59.5 from the 401k. IRAs. An IRA is an individual retirement account where individuals can receive tax benefits upon either contributing or withdrawing. The benefit received depends on the type of IRA that you choose. All IRAs have restrictions on eligibility, how much you can contribute, and then how distributions are made. The 3 most common IRAs are Roth IRAs, traditional IRAs, and SEP IRAs. The Roth IRA allows you to contribute after-tax money for tax-free withdrawals under certain conditions. When we say after tax, we simply just mean that this is the money that's paid to you in your paycheck that's already been taxed. Funds in your Roth IRA grow tax-free, and when you take qualified distributions, you are not responsible for any additional taxes. In terms of limits, you can only contribute up to $6,000 per year to a Roth IRA for the year 2022. And if you're over 50, you can contribute another $1,000 for a total of $7,000. To contribute to a Roth IRA in 2022, single tax filers must have a modified adjusted gross income of $144,000 or less, which is up from $140,000 in 2021. If married and filing jointly, your joint modified adjusted gross income must be under $214,000. Your contributions were already taxed, so you can withdraw these at any time without any taxes or penalties, no matter what. This is worth repeating. You can withdraw your contributions at any time, no matter what, without any taxes or penalties. It's only earnings that really matter when it comes to withdrawals. However, we gotta keep in mind, you should not open an IRA, whether traditional or Roth, with a plan to withdraw your money before retirement, since removing your money does mean you're gonna miss out on market gains and compounding. So, early withdrawals, even if you're not penalized with taxes, should still be thought of as a last resort. If you withdraw earnings and your account is over 5 years old and you're over 59.5, those are also tax-free. However, if your account is less than 5 years old and you withdraw earnings, you might be subject to taxes and penalties if you don't meet the requirements for a qualified distribution. The earnings would be taxed according to your ordinary income rate and incur an additional penalty of 10%. Here's a simple example. If you contributed $20,000 to your Roth IRA over the years, and it is now worth $25,000, your account has $20,000 of contributions and $5,000 of earnings. You can withdraw up to $20,000 at any time because you had already paid taxes on those contributions. However, if your withdrawal exceeds that amount and dips into the $5,000 of earnings, you might be subject to these taxes and penalties. If you're purchasing your first home, you can withdraw up to $10K in earnings, tax and penalty free. If you want to learn more about additional qualified withdrawals, we'll provide a link in the description below. If you want to learn when this type of account might be right for you, stay tuned. We're going to cover that later in the video. Also, hit that subscribe button. If you like this type of content, you're going to see a lot more of it going forward. All right, traditional IRA. A traditional IRA allows individuals to contribute pre-tax income towards investments that can then grow tax deferred. Whereas the Roth IRA gives you the tax benefit upon withdrawal, the traditional IRA allows you to deduct your contributions from your income for tax purposes. You then pay the taxes upon withdrawal. The best way to think about this is, with the traditional IRA, you take the tax benefit up front by deducting your contributions from your income. Funds in your traditional IRA then grow tax deferred instead of tax free. So, when you withdraw the funds, you owe taxes on the full amount. So this tax break is on the front end for those who want to save taxes on their income now, as opposed to upon withdrawal. Contribution limits are the same as the Roth IRA, as these limits apply to the total amount of contributions across your traditional and Roth IRAs. You can only contribute up to $6K per year to a traditional IRA, and if you're over 50, you can contribute another $1,000 for a total of $7,000. To receive the full benefit of the traditional IRA, you can only deduct your contributions from your adjusted gross income if neither you nor your spouse have access to a workplace retirement plan like a 401k. If neither of you do, you can deduct all of your contributions and there is no income limit. This is important to understand, as the traditional IRA's real true benefit is through this deduction up front. Now, if both you and your spouse have access to a 401k plan through work, things get a little trickier. To be eligible to fully deduct your contributions, your adjusted gross income must be less than $68,000 as a single filer or $109,000 as a joint filer as of 2022. If only one of you has access to a workplace retirement plan, your adjusted gross income must be less than $204,000. There are also partial deduction limits here, so as you can see, it gets a little complicated. Your contributions were not yet taxed, so when you withdraw them, they are treated as ordinary income and you owe taxes no matter what. If you withdraw the funds after 59.5, there's no additional 10% penalty. You simply owe taxes on the withdrawal according to your ordinary income tax rate. If you withdraw the funds before 59.5, you may owe that 10% penalty. However, like all IRAs, there are exceptions to this rule called qualified distributions. The main one is purchasing your first home. And if you're purchasing your first home, you can withdraw up to $10K in earnings penalty free. You only owe ordinary income taxes on the full amount. If you want to learn more about additional qualified withdrawals, we'll provide a link in the description below. If you also want to learn when this account might be right for you, stay tuned, as we're going to cover that later in the video as well. SEP IRAs. A simplified employee pension is an individual retirement account that an employer or a self-employed person can establish. The employer is allowed a tax deduction for contributions made to a SEP IRA and makes contributions to each eligible employee's plan on a discretionary basis. Basically, a SEP IRA is a lot like a traditional IRA, but instead is for business owners. SEP IRAs are available for a variety of small business types, including sole proprietorships, partnerships, limited liability companies, S corporations, and C corporations. The plans can be an especially attractive option for small businesses with a few employees. Unlike the other retirement plans, a SEP IRA allows only the employer to contribute, which in the case of a sole proprietorship is the employee as well. The employer contributes after-tax funds into the plan on behalf of the employee, and the funds then grow tax-deferred just like a traditional IRA. SEP IRAs often have higher annual contribution limits than standard IRAs. In a sense, they're a cross between a traditional IRA and a 401k, in the sense that, like the latter, they can receive an employer contribution. Contributions made by employers cannot exceed the lesser of 25% of an employee's compensation, or $61,000 in 2022. When a business is a sole proprietorship, the employee owner pays themselves wages and may also make a SEP contribution, which is limited to 25% of wages or profits minus the SEP contribution. SEP IRA contributions, once deposited, become traditional IRA assets and share the same distribution rules as traditional IRAs. Withdrawals from SEP IRAs in retirement are taxed as ordinary income. If a participant makes a withdrawal before age 59.5, generally a 10% additional tax applies. If you want to learn more about additional qualified withdrawals, There's a long list of them, so we're not gonna go through it now, but we'll provide a link in the description below. We also have another video we're gonna link below that covers all of the IRAs. All right, taxable accounts. A standard brokerage account, sometimes called a taxable brokerage account or a non-retirement account, is the most basic of all account types. Any type of income that you earn on investments, including interest, dividends, and gains that you sell, are subject to taxes in the year that the money is received. Unlike the IRAs or 401k we talked about, there are no tax deferrals or advantages in taxable brokerage accounts. You must be a legal adult, at least 18 years old, and have a social security number or a tax ID number, among other forms of identification, to open a standard brokerage account. There are no limits on how much money you can contribute to a taxable brokerage account, and money can be withdrawn at any time. Although you may owe taxes if the investments you sell to cash out have increased in value. When looking at the capital gains tax that you might owe in a taxable brokerage account, as long as you hold investments for more than a year, your realized gains, meaning the funds that you sold, will be taxed at the lower capital gains tax rate, instead of being taxed as ordinary income, which is much higher. Another incredibly important factor here you have to consider when talking about standard brokerage accounts is tax loss harvesting, which you can only do in taxable investment accounts. So, while there are no tax advantages to this type of account, you can get a significant tax benefit through tax loss harvesting. This is simply a strategy to sell investments at a loss, reinvest the proceeds in a correlated investment, and then use those losses generated to offset ordinary income or capital gains taxes. The value here, especially when it comes to automated tax loss harvesting, is immense. All right, so let's go through some takeaways. First off, employer match. If your employer offers a 401k, in most situations, if they're also offering an employer match, you got to take advantage of this. Employers often offer these employer match contributions in which they'll match your employee contributions dollar for dollar up to a certain amount. This employer match is free money, so you should 100% consider at least contributing up to that amount to take full advantage. If your employer does not offer a matching contribution, you may want to look outside this account. Now, is it better to have a 401k or an IRA? Whether a 401k or an IRA is better for an individual depends on what features are more desirable. A 401k, on one hand, allows for more money to be contributed each year on a pre-tax basis than a standard IRA. A 401k is also somewhat easier to manage for those who don't want to make investment decisions because the plan would likely offer set it and forget it strategies, such as target date funds. A 401k typically has fewer investment options, depending on the financial provider managing that plan. An IRA, on the other hand, can offer more investment choices if it's open with an investment firm such as WealthFront. Roth IRA. If you're under the income limits of the Roth IRA and assume that you'll continue to make a higher income going forward, taking advantage of the Roth IRA could be really advantageous. That way, you take the tax hit now while you're in the lower tax bracket, instead of later in your life when you're paying higher taxes. It's that simple. Also, don't underestimate the power of the Roth IRA for your first home purchase. Not only can you withdraw the contributions tax and penalty free, you can also use up to $10,000 in earnings for your first time home purchase. This can be a super powerful tool to use as one of your main savings accounts for that down payment. Now, we don't encourage withdrawing from IRAs, but it's something to keep in mind if you have to use it. Traditional IRA. Now, the traditional IRA might make sense for those who don't have any plans to withdraw funds before retirement and then think that they'll be in a lower tax bracket in retirement. It also would make sense if you simply like the idea of getting a tax break now and then deferring those taxes to later in your life. And if you think about the time value of money, this could end up working to your benefit. Time is important as ever in IRAs. Now, for the SEP IRA, generally SEP IRAs are best for self-employed people or small business owners with few or no employees. Here's why. If you have employees whom the IRS considers eligible participants in your plan, you must contribute on their behalf, and those contributions must be an equal percentage of compensation to your own. In taxable accounts, if you aren't sure what you're saving for or for how long, you might consider using the taxable brokerage account. This way, you don't have to worry about early withdrawal penalties, although you will owe taxes on any type of income in these accounts, unlike the IRAs. So each type of account has its pros and cons. Thanks for watching. This is Tony from WealthFront. Take care.